So I actually like using Peter Lynch's kind of 6 categories for putting a stock into a specific category. So there's the slow growers, the stalwarts, the fast growers, cyclicals, turnaround, and asset opportunities today. So markets have been choppy over the last few days, and no surprise to the channel as we kind of went over the VIX, where it was sitting. We knew that it was going to possibly rip up, which means that markets could be volatile over the next few weeks. And I do think we'll see some consolidation and possibly test newer highs in the market in February, with a high risk period coming the end of March. Okay, that's kind of been our thesis on the channel, and it's definitely playing out. Now, if you are new to the channel, I have bought some stocks. I'm building a portfolio live, but let me explain exactly what I'm doing when we get into the portfolio here. Now, as you guys can see, my portfolio is down roughly 60 or 70 bucks over the last couple of days. As you guys can see here, the majority of the $29,000, $19,000 is sitting in bonds, and I have roughly over $5,000 still on the sidelines, which gives me a grand total of roughly $25,000, a little over $25,000 of liquidity here. And so I sold into the end of year rally. I thought the beginning of this year could get choppy, and I actually thought the market was pricing in too many rate cuts. Some of the things that we've talked about is obviously coming to fruition and is working out pretty nice. Problem is, I think a lot of domestic stocks are very expensive, and I think there's pockets of distressed assets where I'm taking on that risk. So let's talk about some stocks that I bought today, because I did buy some stocks and starting to build in some positions. First, let's start out with my largest holdings here. Now, the biggest underperformers last year was healthcare, and specifically it was Pfizer and Bristol Myers Squibb that were pretty massive underperformers. And so you guys can see here that with my bonds, Pfizer, Bristol Myers Squibb, and KWeb are my next holdings. So obviously with KWeb, these are Chinese internet stocks, going to be very, very volatile, but I think longer term, there's a tremendous amount of growth opportunities here, especially if the relationship with China and US get better. I like a lot of the holdings that are within the KWeb, and this is going to probably make up roughly 3 to 4% of my portfolio max, currently sitting at right around 1.5% of my portfolio. So I will be doubling my position if somehow the KWeb does go into the high teens area. That's where I'll be looking to double my position on the KWeb. Looking to build out Pfizer and Bristol Myers Squibb as roughly 5.5% of my portfolio, which means there's probably $400 to $500 more I'm going to dollar cost average into Pfizer and Bristol Myers Squibb going forward. I keep repeating myself, but with Pfizer and Bristol Myers Squibb, I think they're starting to get close to a bottom here. They've built out their pipeline, and I think longer term, they're going to be just fine. Obviously, the 1 to 3 year window here, not looking good for either one of these companies, but that's usually the best time to accumulate these types of stocks. Very cyclical type of business here when we think about they build out their pipelines, the patents come off, then they have to reinvest, build out their pipeline. So this ebb and flow of deal making that comes through on these biotech pharmaceutical companies. So new company I added today is Duckhorn Portfolio. This is in the beverage industry, specifically wines, spirits. And when we look at the market cap, sitting right around $1 billion of market cap. Company was founded in 1976. And when we look at the 5-year chart, pretty ugly chart here, as this was a company pushing over $20 a share. It's now trading at $8 a share. But what I want to show you guys is actually the fundamentals have been getting better as the price has come down, and I look at this as a possible opportunity, and that's not the only reason why I bought it. So I want to talk through a few reasons why I bought this company. And once again, this is a higher risk distressed asset. So if you've been following the channel, we've been kind of holding a lot of capital, trying to earn interest on that capital, waiting to deploy, basically 65-70% of our capital into higher quality blue chip names. But while we're waiting, or while we're trying to kind of get those opportunities to where we think it's better entry point, we've been looking at more distressed assets. Now, once again, I don't recommend copying this, guys. This is not financial advice. This is just what I'm currently doing, okay? And at any given time, if things go sideways, I'm going to exit out of this. So there is a stop loss here that I do plan on using. I always recommend dollar cost averaging into a broadly diversified index. Not doing what I'm doing here, okay? What is going on? Well, the price has been slashed by 60%, but take a look at the fundamentals behind the company here. Revenue has gone from $241 million to $403 million of revenue, and the growth is obviously slowing down. And this is not why I bought the stock, okay? I think the valuation is fair on the company. if we were to buy a vineyard and be able to do $400 million of revenue, and the cost to maintain that vineyard and all that, to have a growing company with a $1 billion valuation, to me, is actually fairly reasonable here. I'm not saying it's a screaming deal, but when we look at the forward PE sitting at 12 times earnings, the company has had nice steady growth. It's nothing crazy, but take a look at the steady growth that it's had, from 2019 on. That's just a picture of just steady, consistent growth. And most experts have a buy target on it around $13 a share, which gives it over 50% upside. And once again, this is not the only reason why I bought the stock. Actually, what has caused me to get a little bit more bullish on a higher risk, low cap stock like this, I just look at this acquisition, I look at the company's growth, and I look at the valuation coming down, and I definitely think it's a high risk play, but I also think that it's possibly pretty undervalued. The next position I added today was actually probably jumping in a little too early on this one, was Hewlett-Packard. I was really looking to add Hewlett-Packard under $13. We started a position when it got into the $14 range today. Added a few shares, roughly 25 shares. I really think the Juniper acquisition is pretty interesting. HPE's really talked about being this one-stop AI shop here. I do think that $12 to $14 range makes it pretty interesting. I think anything under $12 makes it very interesting. So we're looking at a lot of distressed assets that I think personally are undervalued when we're looking at the market as a whole. That could they could either go broke, or B, they could really double or triple in the very near future. And so when I look at a company like Warner Brothers Discovery, in 4 or 5 years, would I be shocked if this is a $30 or $40 stock? Not really, especially if they get that debt load under control, keep growing revenue, keep adding subscribers. So they definitely have a pretty large addressable market. And when we think about the streaming world overall, yes, there's no doubt Netflix is winning the streaming world. But if we think about history, when the first ones to the market don't always necessarily win that market, right? We think about MySpace, it was Facebook that really won that market. And there's multiple examples that we can think about that. So yes, today Netflix is winning that market, but that doesn't mean that there can't be another player or multiple players within that market, right? And I think Warner Brothers has a pretty interesting library. I still believe that Paramount is probably the most depressed asset out of all of them, but it also has a lot of risk with it. And so when I look at a Paramount or Warner Brothers Discovery, I definitely think those are asset opportunities where kind of the assets are worth more than the actual stock itself. So if we were to separate the assets out of the stock, you're probably looking at an underappreciated valuation. And I definitely think, asset opportunity falls in line right now with streaming companies. I think Disney could even be put in here. I think we underestimate Disney's capabilities with live sports, having ESPN and the massive content library of Disney as well. And so, when we look at the asset opportunities, I definitely think within there is asset opportunities. The intellectual property is really hard to put a price tag on, right? And then when we talk around turnaround stories, I definitely think that, Hanes Brands is a turnaround story. Their core business, they're still able to sell a tremendous amount of socks and underwear, but can they get back to better margins, profitability? They're getting debt loads down. So that's a big turnaround story. Also, a turnaround story is going to be both Bristol Myers Squibb and Pfizer, right? They've fallen off from their recent highs as their patents are falling off, and now they're building out their pipeline. So these are turnaround stories. So we have multiple turnaround stories within the portfolio. And then I would look at Napa as being a slow grower here. Just slow, steady growth. I think valuation's reasonable on it. I think it's very interesting as a small cap company as well. The acquisition that they recently made makes it an interesting opportunity. So now it comes down to kind of those fast growers that I'm looking for and I'm trying to keep an eye out. And the problem with the fast growers is the valuations are really, really stretched. So as you guys can see, where I'm putting my capital to work is in areas that I think are the valuations I can wrap my head around, and where I need to start deploying capital is definitely going to be on the faster growers and stalwarts. So that's probably what we're going to be focusing on going forward, seeing if those opportunities start presenting themselves in the near future. And with the recent market sell-off, maybe those opportunities are coming sooner than later. So as always, really appreciate everybody's time. As I stated, maybe one video a week is going to be dropping going forward. Going to try to do Tuesdays at 2 p.m. Most likely timestamp some things, as it'll be a longer video updating my portfolio, what's going on economically, and possibly getting into some charts, as the charts did lead us to understand that we could be heading into a double top on the overall S&P 500, lining it up with a depressed VIX, which recently has spiked. And what has happened? Well, we've gotten the sell-off that we talked about coming. I don't necessarily think that this is a big washout sell-out. I don't think any sort of big washout or big sell-off is coming. I think we're going to see more pain possibly in March, and I do think there's still an opportunity for consolidation and possibly hitting new highs. And so if you guys have been following me, you know that I've been more on cash, more on picking my spots in using very little capital and getting looking at the higher risk, higher reward, using very little capital to deploy there. Because I do think that there's going to be better long-term buying opportunities in this market, and we'll see if that's the case. We definitely still have divided analysts, where half the analysts believe that we're going to have a soft landing. More than half the analysts believe we're going to have a soft landing, but there's still some strong cases to be made that we could have a hard landing and that too much perfection is being priced in the market. And I tend to be on that side of the equation as well. I think somewhere in the middle is probably what's going to end up happening, but I definitely think the market's pricing in way too much, especially when we look at forward earnings here. So just my opinion, guys. Hopefully you enjoyed that. And as always, we will see you in the next one.